Well, everybody, welcome to Wall Street Hackers, one of the most watched shows on the Pod TV network, where we broadcast internationally. So this is being seen around the world. And what we broadcast today, of course, is about stocks, investments, and Peter's picks, what you should be looking at potentially for your own portfolio. So with that, we're going to bring in the hacker himself. He's a graduate of UCLA, received his bachelor's degree in economics, the University of Miami School of Law. He also went to NYU, where he received his degree, his MBA in finance, then spending 17 years on Wall Street in New York City, knows a lot about the stock market and knows a lot about investing. So without further ado, let's bring in the host of the show, the host with the most, Peter Bennett. Peter,
Nick,
welcome to your show.
Oh, thanks. And hello, audience. So Wall Street Hackers is on almost every week on Thursday or Saturday, depending on your distribution channel. But next week, we have to take a week off. I have a business meeting. And so we'll be back the week of around 10/26, depending on, again, when you watch in your distribution channel. So we always start with the markets. And what Wall Street Hackers has been saying for well over a year and a half. One, inflation is still out of control. And we're getting a lot of evidence on that it's coming back out of control. Two, the Fed is behind the curve. Three, energy is a key source of inflation. And it's a major, major issue in terms of not only the economy, but also your investing. You know, I always sort of feel negative about certain things going on in the economy, but it's also opportunity for you to make money if you're in the right places, or protect your portfolio if you're in the wrong places. So it is important. I'm going to focus on energy this week because there's so much that's coming out that proves what I've been saying for so long. I wish more people would bring it up, but you hardly hear about the crisis that we're in. Big crisis, little crisis, you judge. But I think it could be a real black swan. So first, a couple of points. One, the unemployment report came out. 336,000 new jobs in September, twice what they expected. So this makes the Fed's job to tamp down inflation really hard, because they're supposed to be bringing unemployment up, not down. It's still going the wrong way. It was considered, quote, a blowout number. And by the way, it's at around 3.8%, which is almost a historic low. So how do you control inflation when people feel they can ask for raises or change jobs for more raises, and every employer is looking for new employees and afraid to lose the ones they have? That's not good news. Then yesterday and today, actual numbers, which was, I don't want to be arrogant about it, but it's exactly what I predicted again. So I said that inflation would be heading up after June, because up to June, for a year up to June, energy prices have been actually going down. But I said energy prices are turning around. They're too low. And we're going to get into energy in a little while. But the thing is that energy had been going up. So now year over year comparisons, and energy is starting to drive inflation back up. So it's going the wrong way. The September PPI, Producer Price Index, came in at 0.5% annualized, 6% annualized. CPI came in today, 0.4%, 4.8%, more than expected, wrong direction, and also nowhere near the Fed's target of 2%. So this is not good for the Fed. It's not good for the fight against inflation. And it's not good for the markets, except for the markets just do whatever they want because they remain delusional. But sooner or later, it will, I believe, wear down the markets. So let's look back to energy now. Wall Street Hackers has said, and I think this is for sure a key thesis that everybody should realize. We believe that oil and gas companies are putting in possibly and likely actually 40% too little capital just to maintain oil and gas production in the world. Now, if we were suddenly short 40%, that would be the biggest shock of the world. I mean, it might even be more of a shock than the biggest wars in some ways, economically. But the thing is, it might not be 40% immediately, but how do I base this 40%? Three things. One, USA Compression Partners, a long-term time investment. We're out of it now, but just because I found better things, but it did keep going up, but it went up a ton when we had it. And it's a pipeline company that ships gas. They know the business. They're in it. They have said that oil and gas companies are putting in 40% too less to maintain production. They might be believed. They're in the industry. Number two, if you just look at what the industry has been saying more and more for a long time now, they're saying there's not enough investment. This is going to be a problem. But wait till you hear all the things that have just come up in the last year and a half, quotes, articles about what's really happening in energy. And three, the oil and gas companies are actually putting in less than half, well less than half of what they used to put in terms of capital. So in up to 2015, they put a lot of money in. Oil dropped in price down to $30 around there, maybe a little lower. And the oil companies just stopped investing. It plunged. But the difference, so they were then starting to do less than half of what they used to do. And keep in mind, these are 5 to 7 year projects. So whatever they do, it doesn't affect you immediately. But the problem is oil prices started rising in 2020. They're much higher now. And oil and gas companies are still not investing. Why aren't they investing? Well, one, you'll hear it in the articles, but two, because of the same 3 points that I make so often. One, the governments of the world, the United States in particular, but many other governments in Europe and other places are discouraging them as much as they can, limiting access to government lands where they usually produce a lot. The Biden administration has created over 100 regulations and barriers to production. Everywhere you look, they're trying to squelch it. And it's because of carbon, by the way. And okay, you can argue that, okay, great. As a footnote, this guy, you might say, this guy's against the environment. No, I am I am concerned about global warming. I think it's hard to say the damage it will do, but it is an issue. But the problem is with the current administration around the world, pollution is going up through the roof. And why? Why is 23 pollution in the United States and the world higher than 22 and 22 higher than 1? Crazy policies. Discouraging oil and gas means more coal, and the world keeps burning more and more coal. Coal demand is actually the highest it's ever been. So they should be attacking logically, but instead they just attack everything. It's just it's like a crazed strategy. So, and also shipping manufacturing overseas doesn't help because China, India just pollute more and more, and they're producing more and more carbon around the world. So they're not making progress. But back to the economic point. So with the oil and gas companies, also putting in 10% of their budgets into environmental projects like carbon sequestration, that money's also off the table. And finally, if they're in a terminal business, and you'll hear something about that, you'll hear one comment about that we should be producing 25% less oil and gas. But if they know they're in a business like that, why are they going to keep investing? They're not. You don't invest in a business that's going to be shut down or that's, you start pulling cash out, which is what they can do in dividends, buybacks, things like that. So let's forget about what I'm saying. Let's just look at this week, just last week and a half's articles about energy. One, U.S. shale producers say they will keep drilling under wraps, even if oil tops $100 a barrel, citing the need for financial discipline during what they see as President Biden's, quote, war on fossil fuel production. Number two, had an energy conference last week in Oklahoma City. Many companies cited the Biden administration's to limit drilling on federal lands and waters as the main reason they are restricting their investments. So oil and gas investment is down when it dropped, and now with it up, they're just not increasing the production. That means an issue. Number three, the Strategic Petroleum Reserve is at a 40-year low. So this hurts us in so many ways. President Biden took a good part of it and emptied it 6 months before the midterm elections, which helped keep oil prices down. This was very suspicious in terms of political motives. But the problem is now, one, with the global situation in Israel and everything, who knows what's going to happen, but the SPR is way down. Number two, it doesn't give us a lot of padding in case we need some more oil and oil prices start going up a lot. Another article. This is from, I'm not sure, sorry, probably Barron's. By the way, all these articles are from Investors Digest, Barron's, Goldman Sachs. I use pretty credible sources. Okay, energy shocks from the 70s haunt the Fed, how history could repeat itself. It's easy to forget that inflation looked nearly beaten in 76. The problem was a new crisis in the Mideast that sparked a whole new burst of price gains. That led to the dreaded stagflation. High inflation coupled with weak growth, a tough cycle to break out of. Yes, it's very tough. Next, the head of OPEC warns of a dangerous lack of investment in oil. OPEC Secretary General said oil investment, underinvestment, is keeping him up at night. If he's serious, he's saying that's a very big concern. He said the world needs to invest at least $12 trillion in the oil industry by 2045 if it wants to avoid higher oil prices. Where's their money coming from when they won't? Why would they put it in? Here's another one, and this is a different angle, but it says the same thing. ExxonMobil just spent $59.5 billion to buy Pioneer Natural Resources, which is a Permian shale giant. So they're paying $253 a share for Pioneer Natural Resources to get more assets. But what they're not doing is drilling. They're just saying, okay, we'll just use the money to buy another producer, which takes that producer out and doesn't increase the oil supply at all. Here's another one. Americans could face, and this is a little indirect, but no, it's really the same thing. So Americans could face catastrophe if the Biden administration continues phasing out existing fossil fuel plants and replacing them with intermittent renewable sources of green energy. The nation will soon lack most of the coal, gas, or even nuclear power stations that have served it well for decades. Without sufficient fossil fuel plants to come to the rescue, solar and wind are napping. When solar and wind are napping, the whole grid comes crashing down. Besides oil prices, we're talking about a lot of issues with the grid. Next, and we're getting to the end of these, but when you add all this up, it's pretty devastating. Some in the oil industry are warning prices could spike higher. The CEO of Continental Resources cautioned that oil could spike to $120 to $150 unless the U.S. government does more to encourage production. I hope it's only $120 to $150. My concern is, what if it's $200 or $250? It's an inelastic product, meaning when people need it, they need it and they're willing to pay for it. And some people are willing to pay for it. It could be a real black swan. So let's look at the other side, what some people are saying. The IEA, International Energy Agency, has called for spending on new oil and gas projects to stop immediately. If the world has a chance of reducing planet heating emissions to zero by 2050, they have to do it now, basically. And that's just, this is again from Faith Burrell, the agency's executive director. He said, despite a huge expansion in renewable energy worldwide, limiting global warming to 1.5 degrees Celsius, which is above pre-industrial levels, he said, he says it will have a catastrophic effect. So he says that we need to lower global demand for fossil fuels by 25%. What kind of an economy is going to lower fossil fuels by 25%? Not happening. First of all, developing countries like India and China want fuel. People in Africa want fuel for their homes to heat it or to drive, things that we're used to cook. So global demand is not going down, one. And two, the danger is of how high oil could go. It really could go through the roof. All right, I got to keep moving because that took a lot, but there was a lot there. This is a very big potential black swan, and your investments should reflect some concern with this, to say the least. Okay, 5 most interesting stories. Number 1, Meta is paying a bunch of high-powered celebrities like Tom Brady, Snoop Dogg, Paris Hilton and somebody, sorry, I don't know, Charlie D'Amelio. Sorry if I don't know who that is, but probably a lot of people do. It's a TikTok influencer. And what they're paying is to basically program their chatbots. And so you'll engage in conversations and it will reflect their personalities. This is just part of what's happening. Robots are coming. Number two, very interesting story. Coming soon, the bite of a European carbon tariff. So the EU is gathering data for a controversial border levy on carbon emissions. Personally, I actually don't think this is a bad idea. So the tariff will hit industrial materials the hardest, but companies as varied as Pepsi and Davida have told investors that the new rule could eventually affect their businesses. The European policies say the carbon border adjustment mechanism has a goal of reducing emissions and making sure that European manufacturers stay competitive with rivals. So there are some pluses to this. It's not a bad strategy compared to a lot of the others they're using. The companies that export the highest volume of steel and others affected include Canada, Turkey, South Africa, Brazil, and China, and India. But this is being implemented one gradually. But the other thing is, it's probably going to raise costs again. So, and they're eventually talking about taxing the oil industry too. And like, oh, that's going to help too in terms of global order shortages. Big, obviously, the story of the week, the Hamas attack on Israel. Interesting story number 3. Basically, the Biden administration did a lot to cause this. First of all, it has allowed Iran to waive most of the limits on their oil production. So they're now producing 3 million barrels a day instead of 400,000. And that oil could go away too. But that gives them so much money. Also, they gave them $10 billion a while ago, maybe it was 6 months ago, and now they gave them $6 billion. And so they're funding the country that's funding terrorism. Now, a Wall Street Journal report said Iran was behind the attack, and that was based on interviews with Hezbollah and Hamas. That's pretty good evidence. Plus, there's tons of other evidence, equipment, training. There's evidence. So the Biden administration says there's no hard evidence in their dreams. Next, the amendment doesn't work, clearly. Maybe they'll change. Another very interesting story, number 4. Weight loss drugs are becoming so popular that the food industry is starting to threaten whether it's going to affect their bottom line. Walmart recently said their food sales and their food sales mix were actually changed and down. And so this could be the start of a big trend with these weight loss drugs becoming popular. I believe 2 million people are already taking them. And the more that take them, people could change their snack food habits, their total consumption of food. Who knows? But there should be concern in the food industry. It creates an uncertainty, and Staples, although I've stayed away from them mostly, but for sure because of the oil crisis and everything, were the place I'm going to go to maybe eventually to add as a safe place, you'd think. But now that raises another question. Finally, interesting story of the week, number 5. Non-binary men pushed out women at the Grace Hopper celebration of women, which was basically a event which is largely a career fair. So what happened is the place was overrun by men in T-shirts, khakis, and giant backpacks, and they gained entry by registering under the rather amorphous non-binary banner of non-binary. So first of all, women at the event were furious. Lots of women, and the event organizer gave a speech about how angry they were at the men because the men were basically taking up spots that were designed for women. But on one side, who can say how many of those men really were binary? So this is one problem with self-identification. If you're self-identifying, it's very hard for somebody to deny it. So this has resulted in 3 kinds of issues, and it'll be an issue no matter which side you're on, although it seems a little crazy that you can self-identify in some ways, but let's say you can. These are going to be issues for those who want self-identification even. One, men are going to slip into places they're not supposed to that are designed for women. Two, the one that's been in the press all the time, female athletes are now being forced to compete against biological men. And three, I was surprised to read this, but female inmates in many states are now being forced to share prisons with violent biological men. So this could be an issue too, whichever way, whatever. It's a bit of a crazy world. Anyway, we'll take a quick break and then we'll get into the investment selection of the week and also our panel discussion. See you in a little while.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
Okay, and we're back. So what to do, what we keep saying, and if you didn't understand what to do, is one thing is to own energy and especially pipelines, and we're going to be talking about that a bit this week, then listen to all those stories again. I mean, energy is such an important hedge against everything else these days, because if it explodes or if it goes up a lot, it's going to hurt a lot of other investments. So it should be part of your portfolio for sure, and not a very small allocation. You know, everybody chooses for themselves. So also own pipelines, because even in a non-energy increasing environment price-wise, they do very well. We'll talk about that in a minute. Own dividend stocks, because the evidence shows, a chart we showed so many weeks, we'll bring it back again, that over 50 years up to 2022, if you own dividend stocks, you outperform the S&P 500 by double. If you own dividend in growers and initiators, you triple the returns, and they were huge returns, especially on the dividend stocks. So, and also be defensive, but everybody's got their own allocations, which brings us into our disclaimers, which are, one, of course, this is for entertainment only. And it's always funny when we say that, but it is. And it's just our opinion. There's no guarantee on anything. Anybody who says there's a guarantee other than a CD, and that's not guaranteed against inflation or fixed investment, you know, that is not true. And you should consult your financial advisor. So this week I'm doing something different, because most weeks for a year and a half now, I've given a dividend pick, mostly energy, but then I pulled out of some of them. They've done okay, the ones I picked, but it's a tough market. But the dividend overall, the portfolio has done really well with the energy picks. And anyway, so this week I'm going back to three, because also with the energy situation and everything happening around the world, it's not a good day to buy a non-energy stock. So I'm going to go with that. And we're going to talk about three that I've recommended recently. MPLX, which is a favorite. I have over 20% in there. I love MPLX. I wish I could find another company like it. I believe they're probably going to have a very large dividend increase, maybe 10 or 15 cents in the next month. I'm not sure, but their cash flow is great, and they have a history of increasing in November. So we'll see. EPD, 3.5% allocation, kind of a clone of MPLX in many ways, another pipeline, and KRP, which is a royalty trust, Kimball Royalty Partners. So first, MPLX and EPD, they're pipelines. Pipelines have historically gotten 17% returns up to 2015 every year. Then they slacked, but now they've been, last few years, they're coming back again. They're doing really well in the last few years. And the only thing that brought them down was when oil went to $20 or $30. So if oil just stays where it is, they should be very strong. They have high dividends. The cash flows are covering it. There are also tax preferences on those two pipelines and KRP in a different way. But if you own an IRA, there's a danger of UBTI. You have to look that up. KRP, Royalty Trust, owns huge tracts of land, oil and gas, about 50-50 in both. Very high yield, covered by cash flow. I'm not 100% confident because even guessing prices on oil and gas are hard, because maybe when oil and gas start going up, it'll crush the economy so much the price will go down, which the pipelines won't be so affected. But if they go through the roof, everything, maybe even the pipelines will be affected eventually. But, and I don't think a lot, but the thing is, it's a great hedge. So I'm 3% there, because if oil and gas doubles or goes 50% more, everything else is in danger, and certainly a lot of investments that I don't like. So panel discussion of the week. So own energy. Panel discussion of the week. Question: how long will it be until inflation is under control? And quick background, in the last few weeks, we've discussed how high we think rates will go, and we've discussed how high we think oil could go. Also in background, the Fed has a target of 2% inflation. Obviously, they're nowhere near that yet. It has brought inflation down for a while, and it's still lower than what it was at the high, but it's still nowhere near, again, 2%. They have affected certain sectors. Obviously, the real estate market sales are way down, and the banks are hurting a bit, and there's going to be some sectors that are hurt. On the other side, there's a lot of sectors that seem impervious right now. Travel is booming. They just raised hotel rates. Cruises are doing great. They're raising rates. Disney's raising rates. So it's not affecting the whole economy at this point. So the question is, basically, with the Fed's higher for longer, how long is long? Nick, what do you think?
3 more years. 3 more years.
Oh, interesting.
And then you'll see as long as they keep the interest rates up, it's having, and the other thing you got to do is Congress has to stop spending money like a drunken sailor.
Oh, good luck with that.
Because remember, the Fed only has one. You have to imagine you ever play a video game and you only have one thing to move around, and that's the interest rates. All the Fed can do is move one thing.
That's true.
Interest rates.
More or less.
Congress gets to move lots of things because they have a budget of $5 trillion, which they suffer a deficit now of $1.5 to $2 trillion. Listen, the Fed cannot do this by themselves. If Joe Biden and Congress keeps printing money and sending it out there, inflation will still be with us.
I didn't even bother to mention that this week.
Yeah,
but I usually do, because there's other factors. That's another factor.
Yeah, and that's
you know what? Good luck. They never seem to cut spending, especially with the divided government, to say the least. They can't even agree where to cut. And plus, there's all the entitlement spending, which is increasing. And most of the stuff is non-discretionary. But, they should be as efficient as they can. But you're right. So I'm surprised you said 3 years, but you could be easily right. But I think it's hard for me to see 3 years out. But I would say I'd be surprised if inflation comes anywhere near 2% in 2025. And, and so we're looking at least a year and a half. And the market, and maybe it starts going down 26. But if energy takes off, we could be looking at 3 years, 5 years, who knows, 10 years. I mean, in the 70s, it was 14 years. Who knows? Energy has been driving a lot of this. And if energy keeps going up or doesn't, who knows? Nobody really knows. But the point is, and there are no guarantees, but in terms of investing, the way I see it is, I think the market's just going to stagnate for sort of like stagflation in a sense. But I think it's going to stagnate. That's my number one prediction for years. Because what probably happened is, first of all, they haven't discounted inflation, but they're so stubborn and delusional. I wasn't going to mention it, but I just 3 delusional days. I have to mention it. So the day the Israeli conflict came out, which is terrible news for the energy in the markets, the day that the CPI and PPI came out, those days, and the day that all of a sudden yields went up, treasury yields went up. Well, very bad news for the market. Up, up, up. It's like no fit, it's like, well, yeah, it's like this delusional state that nothing affects them. But the thing is, if rates stay high, it's going to slowly work on the companies as they refinance. The banks have to refinance, the industries have to refinance as things slow down. So I think it's a real slow grind. So it's hard to say, but my prediction is at least very little progress in 25. Maybe they start making progress in 25, probably 26, and maybe 27, maybe longer, depending on energy. But the market is not priced for this at all. We're priced for a quote soft landing or no recession possibilities, and there's no pain without gain, no gain without pain. Maybe hopefully not the other way, but you have to slow the economy enough that there's some pain in order to slow the economy. Otherwise, people just keep doing what they do. It's the law of inertia. So it will continue until it stops. And that will be when enough people are affected. And we're not there yet because people are spending like wildfire. Consumer sales, by the way, were just up 5% or something like that. It's like year over year. It's like nobody's slowing down because there's not the pain, because they want to do it the slow way. And so I don't think in the end, I think it will avoid pain in the short run, but in the long run, the stock market is very dicey right now. And energy, again, is the real wild card. And with all these predictions, even if we had governments that were willing to encourage, let's say we did have, I try to say non-politics, but let's say, President Trump got back in office, or some other country, they started encouraging production. These aren't turning around these prices. And from an economic standpoint, it's going to take years, 5 to 7 years for a project. So if you go 7 years already without doing enough projects, and they are way short, who knows what's going to happen. But this could be a real black swan, unfortunately, for the economy. And that would really surprise people, again, because the market doesn't even see it. So I'm afraid we're out of time, but thanks for watching. We will, very important, we will not have an episode, I forgot to mention, I think, next week. I did mention it, but anyway, we'll be back. I did, sorry. The week of the 26th, we'll be back as usual on Thursday or Saturdays. And so we're taking just a 1 week break. And hopefully we'll have some good news somewhere from then on. We'll see what happens. So thanks, as Kim always says, thanks for watching, and get healthy and get wealthy. And we'll see you in 2 weeks.
2 weeks. Bye-bye.
Bye-bye, Nick.